Joining us now, Gabriela Santos, JPMorgan Asset Management Chief Market Strategist. Hard not to like what we're seeing. No one wants to fight the tape, I guess. But is there anything concerning in the underlying mechanics of what you look at in the market, Gabriela, or all clear?
So I would say it's never all clear. When we think about the risks these days, it's really two-sided. The first, on the more macro front, there is very clearly a downshift happening in terms of the momentum of economic growth, soft landing, still the base case. But as Chair Powell and the Fed members let us know last week, risks are tilted now to the downside in terms of growth. So for us, the way to implement that in portfolios is still to be risk on. We still prefer equities, corporate credit, but to remember that we shouldn't go to an extreme positioning in small caps, for example, or low quality cyclical stocks. It's still a time to focus a lot on quality. And then the other big risk is just in terms of positioning, valuation, sentiment. And here we come to the more overextended parts of the market, like the Magnificent Seven, and of course, the big focus ahead of NVIDIA's reports tomorrow, as well as some other tech companies. We still find that sentiment and positioning towards the early winners of AI are pretty overextended. And as we saw earlier in the summer, the snapback of that enthusiasm can be painful for portfolios.
So we're done with our growth fears from a month ago when the VIX hit 50. That's in the past. Not going to happen again. What's going to happen next? Do you think that shakes our confidence in staying long?
So I think it's still very much something that's going to stay alive. This idea of, is the economy just downshifting or normalizing, or is this the start of something worse? And hopefully the Fed does get going, and we would prefer at a faster pace to bring rates down closer to normal, to keep the show on the road and even set us up for a better 2025.
So that's where the risk is. You're not worried about inflation coming back. You think that they've accomplished that side of things, and now there may be a lag to all the increases we saw. So the risk is on the economy getting too weak.
I think so. And I think we would agree with Chair Powell and the Fed's assessment that really it's not like there's no inflation risk ever. I think it's going to be a feature of the next decade. Sometimes you have these inflation shocks. But cyclically, it does seem like inflation expectations are anchored again. And really, we're just fighting this very idiosyncratic last two battles of auto insurance and shelter costs. So really, it does seem like the momentum is really much more focused on the labor market. And next Friday, of course, is key, as well as every single Thursday, 8:30 a.m. jobless claims and the whole mosaic of jobs data that comes out. So for us, it's still base case. Growth is just normalizing, soft landing. But I do think in terms of portfolios, whereas before it was diversifying inflation shocks, still need to do that. Plus, make sure that we diversify growth shocks. And bonds finally, again, show that they can help. When we had the 8.5% sell-off of the S&P, the ag or core bonds were up 2.2%. And that's where we see a lot of investors off sides. It's investors that position in equities or they're in cash. And really the work to do and the urgent work is to actually look at intermediate bonds and set up a core fixed income allocation again.
It was interesting earlier. We heard that, 380 is where the 10-year is, and that there's nothing below 380 till 3.25 in terms of the charts. Mm-hmm. So we're going to stay above 380. If we're not going to stay above 380, then your growth concerns are going to be what probably would get us down to much lower yield. So you figure we'll stay above 380 then?
I feel like what we've been seeing is this range around 4%, because I think the long end, less sensitive to just interest rates, more sensitive to the fiscal discussions, which are going to take up the entirety of 2025 around the expiring tax provisions and what that means for the slope of the deficit and the debt. In terms of where we see the biggest room for yields to fall, it's certainly in the short end of the curve, especially your more 2-year and below, which are very interest rate sensitive. The forward curve is telling us rates 18 months from now are probably going to be closer to 3%. So what's the sweet spot there where you can lock in income and get some capital appreciation? It's really that 5-year intermediate part of the curve. So there's no need to go to the extreme and go super long duration. But it is more than the ultra short positioning that we see a lot of investors have on the supposed fixed income side.
So we are in a bull market, and it's going to last a while in stocks.
Yeah, we generally consider that the U.S. goes through these secular bull markets. Really, we've seen that since we came out of the financial crisis. And really because the economy grows over time, earnings spectacularly grow over time in the U.S. We have a lot of conviction that companies are really, really good at coming up with amazing new goods and services to sell their end consumers and preserve margins. And this last earnings season, the last two, have been great to show that margins have stabilized and they're even improving. So secular bull markets that come with these at times cyclical sell-offs, and we've had that 8.5% correction late July, early August, totally normal. In terms of the next bigger downturn, that's usually associated with a recession, when it comes, and that's why we want to have some of those growth diversifiers just in case, but still lean into risk, just given the positive outlook next 12, 18 months, as well as over the next few years.